Hi, my name is Jamie Dempsey, and I'm going to teach you a little bit about stock valuation. More specifically, I'm going to teach you how to evaluate a stock when dealing with free cash flows to the firm. First of all, free cash flows to the firm measures the cash a company has available to pay investors after the company pays its cost of doing business and investments. It is basically used to measure the risk an investor faces in getting a return on his investment. Investors include both bondholders and stockholders. A low or negative FCFF could be a signal that the investment is not safe because there is either a low return or no return. On the other hand, a high amount of FCFF could be a signal that there is low risk and the investment is a good opportunity. We are able to use free cash flow to the firm in order to find the intrinsic value. The intrinsic value is the actual value of a company or asset based on an underlying perception of its true value. It may or may not be the same as the market value. Now let's get into a more real-life situation. Suppose IBM is currently selling its stock for $210. An analysis collected the following data. IBM's FCFF last year was $100 million. Its interest expense was $20 million, and the net debt of the firm increased by $10 million to $295 million last year. The firm has 5 million shares outstanding. If the tax rate is 30%, what is the intrinsic value of the stock given the free cash flow of the firm is projected to grow at 2% indefinitely and the WACC is 10%. Let's review all the data given to us. Free cash flow to the firm at year 0 was $100 million. Interest expense was $20 million. Net debt increase was $295 million. Number of shares outstanding is 5 million. Tax rate is 30%. The growth rate is 2% and WACC is 10%. So the first thing we want to do is calculate the value of the firm. In order to calculate the value of the firm, you take free cash flows to the firm of year 1 all over WACC minus the growth rate. Since we were given the free cash flow to the firm of year 0, we do free cash flow to the firm of year 0 times 1 plus the growth rate all over WACC minus growth rate. By doing this, we are able to convert free cash flows of year 0 to free cash flows of year 1. We then take the data given to us and we plug it into the equation. We are able to calculate $1.275 billion as the value of the firm. Our second step is going to be evaluating our stock. In order to evaluate our stock, we have to solve the intrinsic value of the stock. The equation is value of stock equals value of firm minus outstanding debt divided by number of shares. We plug in the value of the firm that we just calculated and subtract outstanding debt, which is given to us in our data. We then divide by the number of shares also given to us in our data to come out with a number of 196. So what does this all mean? Basically, the intrinsic value of the stock was 196, but its market value is 210. This means that the stock is overvalued. This means you should not buy the stock because their asking price is higher than what it is actually worth. Now you guys are able to evaluate stocks while dealing with free cash flow to the firm on your own. Thank you for listening.